Taxation Made Simple, a guide to understanding U.S. tax brackets. Welcome to planwithvince.com. Navigating the complexities of the U.S. tax system can be daunting, especially with its progressive nature. Unlike a flat tax rate where everyone pays the same percentage, the U.S. tax system requires higher earners to pay a larger share of their income in taxes. This guide will break down key concepts, including tax brackets, adjusted gross income, AGI, and the varying tax rates for different income types. What are tax brackets? Tax brackets are essential to the progressive taxation system. They define ranges of income that are taxed at specific rates. In the U.S., there are currently 7 tax brackets, ranging from 10% for the lowest incomes to 37% for the highest. Your marginal tax rate, the rate at which your last dollar of income is taxed, depends on where your taxable income falls within these brackets. Example of tax brackets in action. Let's say you are a single filer earning $60,000 annually after deductions. Here's how your tax would break down. The first $11,600 is taxed at 10%. The income from $11,601 to $47,150 is taxed at 12%. The remaining income up to $60,000 is taxed at 22%. While your marginal tax rate is 22%, your effective tax rate, what you actually pay as a percentage of your total income, will be lowered due to the graduated structure of the brackets. For married couples filing jointly, the brackets are similarly tiered. The first $23,200 is taxed at 10%. Income up to $94,300 is taxed at 12%. Understanding adjusted gross income. Your tax liability is based on your adjusted gross income, which is your total income minus certain deductions and exemptions. Understanding your AGI is crucial for accurately determining your taxable income and consequently your tax bracket. For example, if you're in the 22% tax bracket, a $1,000 deduction would reduce your tax liability by $220. Knowing how deductions affect your taxes can significantly influence your financial planning. Different tax rates for various income types. It's important to remember that not all income is taxed the same way. Long-term capital gains and qualified dividends are taxed at lower rates, 0%, 15%, or 20%, based on your overall income, while short-term gains are taxed as ordinary income at your marginal tax rate. Annual adjustments to tax brackets. Each year, income thresholds for tax brackets are adjusted to account for inflation, although the tax rates themselves have remained stable since 2018. Here's a quick look at the current and upcoming tax brackets. As you can see, the income thresholds for all tax brackets have increased, reflecting adjustments for inflation. The largest changes occur in the 22%, 24%, and 35% brackets, indicating more significant adjustments for higher earners. These adjustments will impact your tax planning and strategies for the upcoming year. If you have any questions or need further clarification on tax-efficient strategies that can potentially help you reduce your liabilities, feel free to ask. Seeking professional guidance. Understanding tax brackets and their implications can significantly enhance your financial decision-making. For personalized assistance, consider reaching out to Patrick and Vince at UniFirst Financial and Tax Consultants. Their expertise can provide you with tailored strategies to optimize your tax situation and ensure you are making the most informed decisions regarding your finances. Whether you need help navigating the complexities of your tax return or seeking advice on deductions and planning, Patrick and Vince are equipped to guide you effectively.